Learning Objective 3 looks at two things. One is that inventory, of course, is presented on the balance sheet. It is a current asset, and so it has to be valued properly. So we're going to be looking at that. And the second thing we're going to look at outside of the presentation is some analysis. All right. So first, the presentation. Like we know at this point, inventory starts as a current asset, so it's going to be on the balance sheet. One of the rules of GAAP is that we have to list the assets at what they cost us. Okay, we call that historical cost principle. However, there are a couple of exceptions to that rule. That's also part of GAAP. That one you're going to learn about today. Um, and that exception is part of this disclosure that they call the basis of accounting that they use to value inventory. So you're going to be learning the lower of cost or market basis of accounting for inventory. Okay. All right. So again, inventory starts as a current asset. Once it is sold to the customer, it gets expensed as cost of goods sold. So again, the balance sheet is affected, and then later the income statement is going to be affected. Businesses have to disclose their inventory accounts. For manufacturers, it's more complex. For merchandisers, it's relatively easy. They also have to disclose in their financial statements, in their notes, what cost method that they used. So the FIFO, LIFO average cost that you just used in Learning Objective 2, they have to disclose that. And then the last thing they have to disclose is what basis of accounting did they use to value their inventory. And so you're going to be learning about that today. So here's just what some of these notes look like. This is a note for Walmart in one of its financial statement annual reports. And they use LIFO for their US stores. Okay. So that's something that's disclosed. Another thing that's disclosed is they use the lower of cost or market method, which you're going to be learning about right now, in fact. So here's the issue. Inventory is an asset. We usually record our assets on the balance sheet at cost. However, sometimes the value of inventory changes, goes down. So basically, what we have to do before we put inventory on the balance sheet is to double check its real value. And how we do that is first looking at what we paid for it, which we call cost. And then we look at what we would replace it at today, which we call market. And because we want to be conservative in not overvaluing our assets, we simply pick the lower of those two numbers. And that is the lower of cost or market basis in a nutshell. You're simply picking the lower of what you paid for the inventory or what its current market value would be if you replaced it today. Okay, that's it. So how it works is in this nice little illustration from Kentucky TV. My name is Kentucky. Welcome to Kentucky TV. We got a lot of inventory. We got some flat screen TVs. We got some of them there satellite radios. We got some Blu-ray players, and we got some CDs. As you see, we got lots of units of each of them. As you see, there's two other columns here. We got the cost, which is what I bought it for. And then if I went ahead and replaced it today, that's the market. And as you see, I'm going to use the lower of those two numbers to value my inventory. Okay, enough of my character. So here you have flat screen TVs. You have 100 of them in inventory. And as you see, the cost was $600 per TV. But if you replaced it today, the market would bear $550 per TV. That's what you would replace it at. So you're going to use the lower of those two numbers. The $550 is going to be the value of the televisions that you would have in inventory. And you would simply do that with all of your inventory, compare the cost, what you actually paid for it when you bought it, compared to what you could replace it for today if you bought it again today, and you pick the lower of the two numbers. That's it. So the inventory for Kentucky TV in this case would be $155,800. Okay, using that lower of cost or market basis. Very simple. So that's the first thing we're going to be looking at, lower of cost of market. Again, you're looking at two numbers, what you paid for the inventory when you bought it, and how much you would pay for it today if you replaced it. We call it market. And you're picking the lower of the two. So here's another company, Tracy Company. They sell home heating stoves. They have gas stoves, wood stoves, pellet stoves in their inventory. What's the value of the inventory using lower of cost of market? Well, you're just simply going to be picking the lower of the two, right? For each item and adding them up. Really simple. So the inventory for Tracy Company would be worth $430,000 by using the lower of cost or market value for all of its inventory. Piece of cake. The second part of this objective is about analyzing inventory. Inventory is critically important, right? Because that's the only thing merchandisers do. They buy inventory to sell inventory. That's that's their entire existence is based on inventory. So if you're actually really good at inventory management, there are a lot of great opportunities for you in the world, for sure. So what are some of the extremes that happen with inventory? Well, one extreme is you have too much inventory on hand. So when you have high inventory levels, you've got major problems because first of all, you need to store it. So you're going to have costs for warehousing many items. You probably bought the inventory or part of it on account, so chances are you might be incurring an interest cost for that. Certainly, if you're not if you're not incurring an interest cost for your inventory, you certainly have cash tied up in your inventory. I mean, that represents cash to you as well. You want to turn it into cash as quickly as possible. And then, of course, inventory can get old fast in some cases, right? Either technology changes or fashion, changes, and boom, what you thought was great today is out of favor tomorrow because something new and exciting has hit the market. So too much inventory costs money and it weakens profits for sure. When companies have big sales or clearance sales, they're not making any money. Remember that sales revenue might come down in price, but the cost of goods sold didn't. And all their other operating expenses like rent, except that didn't go down either. So when you lower your sales revenue, you're lowering your profit as well. So bad idea to have too much inventory. On the other end of the scale, having very low inventory could be very frustrating, mostly for the customer as well. The customer walks in thinking you have a certain thing for sale because that's what you're known for, and you don't have it. I mean, how infuriating it is to be a customer to walk in knowing that you've usually purchased these things here and they don't have it anymore. Well, what does that mean? Well, for the customer, they leave very angrily. For the business, they've lost a sale. If you've lost a sale, you've lost your profit as well because they go together, right? Profits come from sales. You lose sales, you lose profit. So this whole analysis thing on inventory, critically important. Two ratios that you're going to be learning about that are really very practical ones to know. The most important one is the inventory turnover ratio. So the word turnover here is very important to understand because the reason that businesses buy inventory is to sell them. After they sell the inventory, they restock. That's turnover. Right? They want to put more of these things for sale, so customers buy them. the shelves get a little bit more empty, they put more on it. That's turnover, right? How quickly are you selling your inventory? Because that's your whole life depends on selling inventory as a retailer. So this ratio looks at how many times per year the store is actually selling out, basically. And to get that, it's the cost of goods sold divided by an average inventory. So you have beginning and ending inventory divided by 2 to get an average inventory. Once you know this ratio, you put it under 365 and it actually converts to the number of days you've had the inventory there. So let's take a look at an example with our friends at Walmart. Here is the ending inventory for 2013 and 14 and the cost of goods sold. You know your ending inventory for 2013 is your beginning inventory for 2014. Right? So this is why these two are given to you. Okay, cost of goods sold for 2014, 358 billion divided by about 44.2 billion in inventory, average inventory. Walmart has a ratio, inventory turnover ratio, a little over 8 times. That's 8 times per year. Think about it. Look how big a Walmart store is. They have like 120, 130,000 items in a Walmart store, not including the grocery place. So imagine that. They sell all of it and restock it roughly 8 times a year. It's just crazy to think about it, but that's what the inventory turnover will tell you. How many times per year the store turns over its inventory, sells out its inventory, restocks. When you know it's 8.1 and you put it under 365, you can see that basically in 2014, Walmart is selling out every 45 days. That's just an enormous amount of inventory to move. Very, very quick. Compare that to one of its main competitors, Target, for the same 2014 period, and their inventory turnover is 6 times a year, 6.1. So roughly Target is selling out its store and restocking about 6 times every year. When you put that under 365, it's going to come out to roughly 59.8 days, if we can round, about 60 days. So they're selling out every 60 days. That's still a very, very good pace to go on. Clearly, you want to have as high a inventory turnover as possible because you're selling goods. And if you're selling goods, you're making profits. The industry as a whole is reflected more toward the Walmart numbers. The large department stores are very good at selling inventory. They clear these things out pretty quickly. Okay. When you look at the example for inventory turnover at the end of the chapter, you will see that it has a company called Westmoreland, and they're asking you to calculate the same ratios, inventory turnover ratio and the days in inventory for both 2016 and the year 2017. The numbers are there. So what do you need to get the inventory turnover? Well, you need cost of goods sold. This is your starting point. And you're going to divide that over average inventory. So you take beginning and ending, add them together, divide by 2. That's how you get an average. Once you get that inventory turnover ratio, you put it under 365 to get the number of days. So notice in 2017, the ending inventory for this company dropped substantially because they switched to something called a just-in-time inventory system, which is mostly what retailers run on today. So just-in-time inventory means that retailers don't have a lot of inventory in the back room in stock. They basically put everything out there with very little left in the back room. Why is that? Well, because they don't want to tie up their money in inventory. And if they see that sales of items are going very, very well, they'll simply pick up the phone to either the warehouse or the manufacturer to get another delivery just in time to sell it. Okay. They want the turnover to be high. That's another reason why just-in-time inventory is very popular. They want that. They just don't want to hang on to inventory. They want to grab it, put it in the store, sell it right away. Right. So when you look at the solution for both years in 2016, their inventory turnover was 4 times per year. That's $1 million in cost of goods sold divided by $250,000 in inventory, average inventory. When you put 4 underneath 365, there basically has a days in inventory about 91 days. So every 3 months, they're basically selling out their store. But look what happened with the just-in-time inventory system. Their average inventory is very low, which means they're selling more of it at a faster clip. Okay. And so that's a higher rate is much better because when you put that under 365, you're going to get a shorter period of time. Okay. So this company improved from selling out the store every 91 days in 2016 to selling out every 52 days, which is much more preferable if you're a retailer. That's what you're in business for. You just want to sell the stuff as quickly as possible. So turnover is important, and it's something you have to know. But like I said, not a lot more in chapter 6, not much to it.